the precursor to the crisis. You can see in August of '07, the London Interbank offer rate OIS spread started to go up. It blew out to incredible levels in the fourth quarter of this year, and the flight to liquidity. It's come back in, but still is very elevated relative to history. This spread needs to come in, continue to come in for the economy to get better and to heal. Okay, one of the things that you hear, at least we hear over in the U.S., you probably hear over here, is that banks need to lend more, that banks aren't lending, that people can't get credit. That is not the problem. Banks are lending. As you can see, in 2008, commercial bank lending was up 5.6%. Business lending was up from banks was up 10.6%. Real estate loans from banks were almost 6%, and consumer lending from banks was up 9%. Hey, what is the problem? The problem isn't banks aren't lending. The problem is the next thing, is the so-called shadow banking system, which consisted of hedge funds, investment banks, money market funds, structured finance conduits. That was the source of about 60% of all of the incremental lending. That's the so-called securitization markets. That is what is shut down. It would be, in fact, it's extraordinarily unusual for banks to be having increasing lending at all during an economic contraction because credit demand falls. What's happened is that the securitization markets have collapsed, which has led banks to try and step into the fray. Banks, of course, have capital problems, so they can't, in fact, even if the banks had no capital problems, they could not make up the difference in securitized finance. And the shadow banking system is not coming back anytime soon. But what the Fed is doing, and I'll probably mention this a little bit later, is their so-called TALF facility, the Term Auction Lending Facility, is designed to put about $1 trillion of new credit back into the securitized system. That's just about the entire amount that has gone out. And to the extent that that is successful, and it certainly will be partially successful, that will make a very big difference in credit availability and in confidence, and therefore in behavior, which again is what Keynes indicated, and I agree with him, that you need to change behavior. Okay, in terms of equity investments, I'm an equity investor. The Morgan Stanley Capital National Index fell 54% last year. It was a complete disaster, as you know. Of the 312 major worldwide indices tracked by Bloomberg, only 8 are up and 304 are down in the last 12 months, so not much decoupling there. The crisis does continue. This is just some headlines from the last week or so before, as I was putting these slides together. Japan government faces calls for bigger stimulus. GM needs $6 billion more. Russian industrial output down 20%. Texas firm, that's Stanford Financial, includes of $8 billion fraud. California tries to close the budget gap, which they were able to do with the Republican defecting. And then Asian joblessness to balloon from the Wall Street Journal. Okay, so that's sort of a synopsis of the crisis. Asset-based, collapse in securitization markets, collapse in confidence. Okay, so what are the authorities doing to that? Well, here's what the global stimulus packages look like as of about last week. And so there is a global coordinated response, which is critically important to ending the crisis. If you go back and read those Keynes essays from the 1930s, he makes it very clear back then, and it's very clear right now, that England could not pull England out of the crisis, and that it couldn't pull the rest of the world out of the crisis. It had to be a coordinated policy effort. We are getting that coordinated policy effort right now. That's the good news. The bad news is that those numbers on that column, percent of GDP, are very small relative to the size of the crisis. Only China, which is about 3/4 of the way down, at $586 billion and about 9% of the Chinese GDP, is large enough to make a difference, significant difference in my judgment. It's interesting to me that the Chinese market is one of the very few markets that's doing well this year. It's up about 14%, having been up about 25%, but having fallen in the last week or so. But you're actually seeing an increase now in consumption in China relative to what they'd had before. The Chinese stimulus program is starting to work. If we had stimulus programs of that size globally, we would come out of this contraction a whole lot faster than we would otherwise do. This is the U.S. government's stimulus package, about $787 billion. You can see it's broken down in a wide variety of different areas. It really doesn't matter all that much where it's going. It matters what the aggregate is as a percent of GDP. It's a decent package. It's not big enough, again, in my judgment. Down at the bottom, you see tax cuts and aid, which is more than half of the size. The tax cuts, part of it, while maybe good social policy long term, will do very little to stimulate demand, because most tax cuts in this environment will not be spent, they will be saved, which is part of the problem, is lack of consumption and lack of spending. And while we need savings rates to go up, the aggregate of savings rates going up into a falling demand environment is not a great picture. Okay. Part of the good news is the Federal Reserve has finally decided to expand their balance sheet dramatically. They did it after the failure of Lehman Brothers in late September. This is just a picture of, and it's not really important what all these different facilities are. The important thing is that you can see that beginning in September and into October of 2008, that line bulges up at the top, and that's what it needs to keep doing. Okay, this is the key to getting out of this thing. This is why we will get out of it, and this is why it's actually inevitable that we will get out of it, and the only question is the speed. I mentioned earlier that really busy slide about the 9 stages of a depression came from Irving Fisher. This is the Irving Fisher's monetary equation. It's fairly simple. It's MV equals PQ. M is money, like what you have in your pocket. V is how much you spend it, the velocity of it. P is the price that any good can trade for, and Q is the quantity of goods. So the PQ is just the total amount of GDP, and it's a function of the amount of money in the system and how much is being spent. The problem in this environment is the opposite of the problem in an inflationary environment. As I'm sure you well know, in an inflationary environment, the problem is the so-called too much money chasing too few goods, meaning there's too much M and V and not enough Q, and so P goes up. In the environment that we're in right now, it's exactly the opposite. We have too many goods and too little money, which is why we have production being cut all over the world, why asset prices are falling, why commodity prices are falling. There's too much stuff relative to the ability to buy the stuff. And the ability to buy the stuff, what's fallen off is not currency in circulation, but credit. And so we've got to make up for that ability to buy the stuff through credit through the actual putting of money into the system. The previous graph that I showed you of showing that bulge, that's the Fed putting money into the system. So far, they have not put enough into the system to offset the drop in V, meaning the willingness of everybody in this room and people in the rest of the world not to spend so much. So until they can get more M out there than V is falling, P and Q are going nowhere. But you can be assured that that is the task at hand, and they will get the money into the system. That's part of what this so-called TALF is trying to do, and then this public-private partnership to buy toxic assets is also part of that, and I think that's something that could work out quite well. Okay, here are some lessons from past crises, and I'll skip the first part of it and just say that focus on that second dot. Banking crises are similar across developed and middle-income countries. This comes from a paper by Ken Rogoff in December of this year, and it's entitled Banking Crises and Equal Opportunity Menace. So they studied every banking crisis in history, every asset value crisis, and pointed out the commonalities, and they are similar into frequency and duration, real house price declines, partly because real house prices tend to be a source of this stuff, and then also the duration of home price declines. What I want to call your attention to are the difference between the two sets of bars on the left to the 2 sets of bars on the right. So the 2 sets of bars on the left are, one is real equity prices and the other is real home prices. As you can see, we are almost at the level of decline, the average level of decline in all major banking crises in terms of real equity price declines, meaning we're almost there if this is anything like these. And these aren't garden variety recessions. This is the big stuff that's happened, going back, actually they went back I think to the 1600s in this. Also in home prices you can see we're almost there. Where we aren't there is in peak to trough GDP declines or in changes in the unemployment rate. So you can expect globally more declines in GDP and more bad news in those numbers, more unemployment globally. But, and this is the beginning of the optimistic part of this, is that because capital markets have adjusted so rapidly to this, you are likely coming to the end of the declines in asset prices and especially in capital markets prices, coming to the end of the decline in fixed income, meaning the end of the credit spread widening, and the beginning of stabilization in those. Stabilization would then be followed by increases in the values of those assets, and that's how you would know then that the entire process has begun to heal. Okay, this is a timeline to recovery. This comes from Mark Zandi at Moody's and economy.com. He was very early in calling the beginning of this crisis. Unlike somebody like Nouriel Roubini, who's all over the press and is you know, I think making, as he should, making quite a career out of being pessimistic, because he was early and he was right, and he gets a lot of publicity in this. Mark Zandi was also early and right, but I think he's more down the center of the fairway than Dr. Roubini may be at this point in time. But in any case, if you look through this, this is sort of a timeline to recovery. He has home sales bottoming sometime in the first or early second quarter of this year. We're already seeing that. Home sales hit an all-time low in the release last week. Housing starts bottoming again sometime in the second quarter. That looks right. Housing starts are bouncing along all-time lows. Housing prices may be bottoming in the fourth quarter. That's now becoming consensus. Then foreclosures peaking, failures abating. The thing that's most interesting here, he's got the jobless rate peaking in the second quarter of 2010. Again, that's probably Fed, I think that's Fed consensus right now. Most importantly, Fed tightens in the second quarter of 2010. As you may know, the Fed has said they expect interest rates, the Fed funds rate, to stay at 0 to 25 basis point for a, as they say, quote, considerable period of time. If the Fed if this is a reasonable timeline, and of course nobody has a crystal ball into the future, but it certainly follows a reasonable timeline. If the Fed's going to be tightening in the second quarter of 2010, the only way the Fed tightens is if capital markets are doing really well. So what this forecast from Mark Zandi is saying is that you're going to have really good bond markets and really good stock markets by the second quarter of 2010. Otherwise, of course, the Fed would not even begin to think about tightening for the same reasons they did in that early slide I showed you when the Taylor rule said that they should. Okay, so in terms of risks and opportunities coming into the home stretch here, the three major risks, I think, out of this crisis: global inflation, protectionism, and policy errors. In terms of risk factors, the immediate risk factor is there sufficient demand for the burgeoning debt issuance? Every country in the world is running big deficits. Every country in the world is issuing massive amounts of paper. And countries that do not have balance sheets that are as strong as others have fairly significant risk attendant to that, either to their currency or to their overall longer-term solvency. The key to dealing with this risk factor is global coordination and cooperation. I think that the picture there is, I would say, at best mixed. It's not bad, but it certainly isn't good. Today we saw on the headline that in the EU they decided not to offer any aid to Eastern European countries or to the auto industry because the EU was concerned about the effect on their balance sheet of so doing. Again, this is a repeat, a very similar thing that we saw in the 1930s, that as you have a major crisis and a major thing to deal with, and instead of dealing with that, they're concerned about secondary effects of that. So I think that that's the thing that you've got to watch out for, is the concern about secondary effects. We came out of the crisis in the 1930s, actually beginning in 1933, with a major expansion of the money supply, leading to really good stock markets in 1933, 34, 35, 36. And then what happened was people thought that because unemployment in the U.S. now had fallen from 25% to 10%, that we were out of the woods. And so they decided to go back to the normal policy, and in 1937, the Roosevelt administration raised taxes and balanced the budget, causing a collapse in the stock market and a continuation of the Depression until World War II. So I think that watching out for policy errors, and policy errors are a major part of the risk factors here. Japan is a continuing risk factor just because of its size, the second largest economy. I know we have the distinguished ambassador from Japan here in the audience today, and he told me earlier that he was quite optimistic about Japan doing the right thing. So I would trust his judgment on that one. But one of the concerns is that Japan, they were the largest holder of Treasury bonds. They still may be, but China is certainly coming up on that. China is the largest buyer of Treasury bonds. But the outlook for Japan continues to be poor, certainly in the near term, and those are just some aspects of that. So it's important that Japan not contribute more than it already has to the global economic difficulties just because of the size of that overall economy. Okay, the U.S., despite the trillion-dollar-plus deficits, is in far better fiscal condition than many people think. This is a chart of general government gross financial liabilities as a percent of GDP. As you can see, Japan leads the list at 173%, Italy 113. The U.S. is down there among developed countries at only 63%. So there's a lot of room for the U.S. to expand its balance sheet, and I think that it would be good policy for it to do so as rapidly as possible. Okay, so let's look at what's actually, I think, underpinning a more optimistic outlook as we're in this midst of tremendous pessimism. Okay, the Fed has put over $1 trillion in the U.S. banking system and $600 billion in the global banking system. Since the fall of last year, Treasury, corporate, and mortgage yields are lower, in addition to having the lowest Fed funds rate in history. And very importantly, the initial effects of the expansion of the Fed's balance sheet take about 6 months, and the full effects take about 2 years. We got the expansion of the balance sheet beginning in October, which means we should begin to see in the statistics the impact of the money supply growth on GDP and on macroeconomic statistics beginning sometime this month or next month. So not next year or the year after or even late fall, sometime this month or next month. And that will be an important indicator. If we're not seeing anything by next month or into May, then I think you're going to see the Fed really, really step on the accelerator. But when you run through the numbers, there should be beginning relatively quickly an impact on that. In fact, our sister company, Western Asset, which, as you know, is one of the largest bond managers in the world, their chief economist sent a note out a couple of weeks ago saying that he actually thinks there could be a chance, contrary to what everybody believes, that U.S. GDP would grow in the second quarter of this year. I think that's pretty optimistic, but his data on this is reasonably compelling, that if it's not the second quarter, it'll certainly be the third quarter. If that's true, again, capital markets should be beginning to respond and bottoming right in here. Okay, lastly, business cutbacks have been very dramatic. They have gotten, I think, ahead of the curve, and I think that the more dramatic cutbacks are much less likely than what we've already seen. And importantly, growth can come from the inventory cycle. You can look at this chart. This is a long-term chart of the inventory to sales ratio, and you can see that that's been dropping, and it's very well contained. Any increase in inventories, of course, leads to production increases, which leads to sales, which leads to income increases, and this leads to spending increases. So that is also a potential surprise factor. That line is below trend, and inventories are in very good shape in most companies in the U.S. Okay, but what about the pessimism? Well, I've got some quotes here from some people just to give you a sense. This is sort of the overview from Barton Biggs, former head of Morgan Stanley's asset management division. This is written right at the bottom in November, which is where most companies made their bottom in that fall of last year. He said, "In every bear market I have seen, the doomsayers concoct a statistical argument that the glory days for stocks are over because a flood of selling by brutalized investors is inevitable and the buyers have no money. This case always seems most compelling close to the end of the decline and is always marked by a wave of media pronouncements. The bottom of a bear market